Okay, I guess we're ready to go. I'm Jay Taylor, the editor of Jay Taylor's Gold, Energy&Tech Stocks, and I host a radio show called Turning Hard Times into Good Times. You can follow that the following day by podcast at Jay Taylor Media. 2019, which safe haven markets will dominate? And this is the theme that I've been talking about at the Metals Investor Forum this year. My assumption is that the equity markets are going to be in trouble before the end of the year, and that in fact the global economy is heading is slowing down at best and probably heading for some serious trouble. Whether that happens this year or not, I think there's growing signs that we do have a weaker economy. We certainly have the trade conflicts, which are not helping, and we also have some very troubling things on in the capital markets, which I'll be talking about. So this is the issue, is which safe haven will win out? Will it be treasuries or will it be gold? And by the end of August of this year, we're seeing the treasuries are winning. They're up 38, I'm talking about the T-bond, the 30-year treasury bond is up 38.23%. Gold, both of those assets have come down a bit since then, of course. Gold is down a lot now, I think around 15, just a little over 1,500 earlier today. But the point is that there's money moving into both of these safe havens this year. Of course, the bond market, the treasury market is mammoth compared to gold. So the amount of money that's going into the treasury is obviously much larger. Now, the problem that we have is that we have something called Keynesian economics that has been ruling the day in the Western world, at least since World War II. John Maynard Keynes, the idea of printing money to create wealth, or the government always spending money created out of nothing, essentially, and get rid of the gold standard, which is what happened in 1971 completely. But what you see here is with each cycle, each credit cycle, you have lower lows and lower highs for interest rates. And the reason that is because the debt with each cycle, the debt that is built up is never expunged. The debt is always there, and it just keeps growing and growing. So the level in which interest rates can rise keeps falling before the system topples over. And so after this latest quantitative easing, the Fed has tried to lift rates, but only to around 2.5% now. And so that's a big problem. It can't raise it anymore, or the stock market topples over, and the Fed chairman starts pumping money, and the President of the United States screams very loudly as well. Now here's the issue we have around the world: negative rates. You can see even in Germany, across the whole yield curve, negative rates. And more of this is happening. The pink area, the orange area there is all the negative rates. The US, of course, has remained positive, Italy, but this is what's happening, because the quantitative easing is the only thing the central banks know to do. Actually, what this is, though, is a contagion effect is going into the United States as well, because all around the world, pension funds or people are looking for positive yield, and so they're buying U.S. debt. They're buying positive yielding U.S. bonds and corporate debt as well. And now we're seeing that 94% of all investment grade debt in the world is now dollar-denominated investment grade debt. So what's happening is that all the European Union and the Japanese and everybody is printing tons of money, pushing their interest rates into negative territory, and the money is flowing into the U.S. So no matter what the Fed tries to do, as long as money flows in here, it's going to keep pushing the interest rates down on the treasuries. And I think that's part of the reason that the dollar is holding up as well as it is now as well. So I think there's really a slim chance of that we're going to see any rate rises anytime soon. With the global weakness that's going on, as I mentioned, just too much debt. The central banks can't raise the interest rates without toppling the system over. And as normally, to get out of these recessions, the central banks have required about a 5% drop in interest rates. Well, we're only at 2.5% roughly, the U.S. interest rates. Or less. I mean, the 30-year bond is below 2%. The other day, anyway, it may have come back. I haven't checked in a week or so. So this is a real issue. Now, one economic concept that seems very logical to everybody except Keynesian economist, and the classical economist understood this very well. Time preference. I mean, if you just think about it, if you have money, you want to lend the money, you'll let go of that money. It has value now. It has more value now than it's going to have in the future. So if you lend the money out, you say, I need to have a positive interest rate. You have in your own mind what your time preference, how precious that dollar is, and how much of an interest rate you need to get in return to let go of that money. Same thing applies to other things, to commodities as well. So you have time preference. It's a concept that's very, very important. Of course, risk, consumption, if you need it now, you might let it go and you need more money, more interest rates, more of a higher interest rate. Or investment opportunities, obviously. You'll let go of your money now, thinking that in the future you hope to get a lot more back. So a positive yield curve is what is really good, and the bullion banks, the gold bullion banks, love this curve, because what it's meant is the bullion banks could borrow gold, sell the gold, take the proceeds and buy treasuries. Now the time preference rate or interest rate for gold has been about 1.5 or 2%. That's in the forward market, so we know what collectively the market needs to have to let go of its gold. So that worked as long as you had a positive yield curve, as long as the bullion banks could borrow gold at 1.5 or 2% and then get more than that for the treasuries. I mean, 4, 5, 6%, they were making money like crazy and then leveraging up on it. Big bucks made by the bullion banks, so they were borrowing the gold, selling it into the markets and no doubt driving the price of gold down too. That would have that effect. So this is what we have now. This is the yield curve. I just got this before I left New York. Gold bullion banks curse, I call it, because it's the opposite. And the gold bullion banks are now finding themselves losing money on the gold carry trade. So what they're doing is going out and borrowing, they're buying gold on the markets and unwinding that trade because they're losing money on it. And so it's a short covering of gold that is no doubt causing this. Causing the rise in the gold price right now. And it has everything to do with this time preference and this negative rates or very low interest rates. Now, David Stockman is a former U.S. congressman. He's a budget director under President Reagan. I had him on my show this last week, and I posed the question to him, what if the U.S. dollar, the world's reserve currency, goes into negative rates? And he says, if that happens, it's game over. He says it's all over, but the shouting is the way he put it. So, the distinction between, say, the euro or the Japanese yen with negative interest rates is profound, because as the world's reserve currency, everything is measured and quoted in US dollars. So if the dollar interest rates go negative, there's no reason to hold them anymore. You'll buy something that has a positive time preference, gold or silver, or ultimately all commodities as well would have a time preference. And I think we saw this a little bit in I saw it, I'm old enough, in the 1970s. And then of course Paul Volcker came in and slammed the brakes on the money supply and drove interest rates into double digits. Gold crashed. And we had, a long time of very positive growth in the United States, because we had people would actually not consume right away. They would save their money, and that provided the capital that allowed the United States to grow very dramatically. So I think low interest rates, they haven't gone negative, but they're arguably below the time preference for the dollar for many, many people anyway. And so people are letting go of their dollars. Now, Alistair MacLeod, who I'll introduce to you in just a moment, so I had him on my show just recently, and he really makes this distinction of the interest rates, the negative rates, and how profound it is if it occurs with the dollar. And he thinks that will probably be the end of the dollar as the world's reserve currency if that happens. Well, for obvious reasons, if everybody dumps the dollar. And I just showed this slide because back in January 1988, the economists predicted that there would be a new currency by 2018. Well, they missed that one, of course. But what also happened by that date was the opening of the petro yuan trading in China, and also the ability for international trade in gold in Shanghai as well. So there is now that's important because the United States dollar has remained strong over these many decades primarily because of two factors. After the United States went off the gold standard in '71, Henry Kissinger went to Saudi Arabia on behalf of Richard Nixon and arranged a petrodollar trade. We said, we will keep your family in power with our military might if you make sure that OPEC demands payment in dollars. And that kept a bid under the dollar for all of these years. Of course, we also then used our military to enforce that and to overthrow governments that decided, like Saddam Hussein did, arguably in Libya as well, to get rid of people that wouldn't cooperate with the United States dollar system. But the economists saw it coming. Reserve currency status doesn't last forever. This is just a little history here. You can see the length of time, arguably the British, the French, maybe Spain had a little longer time than we have, but the time that we've had the world's reserve currency is similar to Portugal, the Netherlands. So we've had quite a run, and we've been able to live beyond our means in America by printing money, and the rest of the world being forced or being willing to take it. We exported our great jobs, really wealth-creating things to China, and they have run positive trade balances for many decades, which is also a characteristic of having the world's reserve currency. You have to run trade deficits in order to have enough dollars sloshing around, or currency, your currency, the reserve currency, to make sure there's enough liquidity that you can continue to be the world's reserve currency. So our policies, which Mr. Trump is trying to unwind, I think, were to make sure that we ran trade deficits, which then hollowed out the middle class and the manufacturing and the mining and various real wealth-creating jobs in America have gone other places. So if you think that this is just some crazy gold bug up here talking about the end of the dollar as the world's reserve currency, here's Mark Carney, who just said that the other week in Wyoming, calls for the global monetary system to replace the dollar. This is no secret now. The dollar's days, I think, are numbered, and it's going to have a very profound impact on all of our lives. I think when and if it happens, I don't know when, nobody does, but it certainly seems to be getting close. And this negative interest thing, watch it very closely, because I think if it comes to America, we're going to be, how can the dollar remain a reserve currency? Again, that time preference is the issue that I think will drive it. And of course, we're seeing central banks buying more gold now than they have any time since 1971, or since Nixon took us off the gold standard. But they're not banks that are friendly to the United States. They're banks that are in competition globally, economically, militarily, I would argue, in the future, as China is really gearing up, and Russia too, with some fantastic new technologies, as I understand it, in military technologies. So I would argue that it's maybe not this year, but we're starting to see the rise in the gold price. We're seeing a lot more money going into treasuries, but when the dollar is no longer the world's reserve currency, how in the world can it remain? How will people continue to buy treasuries? Why will they not go to gold and copper, and let's say silver next, copper? As Alistair MacLeod reminded my listeners, all commodities have a positive time preference. So it could be copper, it could be zinc, it could be nickel, it could be probably all of he thinks that the whole commodity complex will go into backwardation if the world's reserve currency goes into negative yield. So here we are. I should have updated this slide because I know it's a little different in terms of the relative gains of treasuries. This was the last day of August. Where will gold go? Well, I think that's kind of a silly question in a way, because if the dollar goes to zero, the answer is it's an infinity. That is really hard to say, but we do know that the budget, the CBO, the American budget, the U.S. federal budget, and gold with a 250-day, I think, lag, were very closely correlated until 2011 when gold peaked. I believe, and I'm not sure why, but I think it's because probably people just got confident that the Fed had their backs in the equity market. And the equity markets have been going crazy ever since that, and the treasury markets as well. So why wouldn't you just stick with gold? It's working so well. I mean, with dollars, it's working so well. So if you use the CBO's assumption, and that's the Congress's budget organization, looking at their assumptions, and their assumptions are usually not very conservative. They're assuming there'll be no recessions, they're assuming all kinds of fantasy assumptions, that we would be looking at something like $5,000 gold now if that correlation had continued. But of course, $5,000 gold is a threat to the dollar system as well, and you can bet your bottom dollar that the government and the Fed, the deep state, if you want to use that word, will do everything they can to try to keep control of the dollar as long as they can as the world's reserve currency, because if you topple that, the elites are going to be hurt, and there's just going to be tremendous changes taking place. So here we are again, the chart. We're clearly in a bull market, the start of a bull market in gold. I think it's hard to argue that otherwise after about 6 years of treading sideways, building a base. Which brings me to the most important people that come to this show, the ones that actually create wealth in the ground, do fabulous, really difficult things, and I wish Americans understood more about what it is and what it goes into building a mine and creating wealth. But these are really the basic wealth creators sitting up here. I've invited Avino Silver and Gold here because they've been a solid silver producer for many years, and I believe that silver will outperform gold as it normally does during bull markets, during precious metals bull markets. They're selling for under $1 in U.S. money anyway, and trades on the New York Stock Exchange. I think it's a no-brainer, and they've got a gold project that looks very promising. David Wolfen will talk to us in just a moment about that. I've been following Balmoral for many years. Really, they sort of stumbled on a nickel project that's turned into quite a deposit, and Darren will talk to us about that in a minute. But more recently, they also have come across a very promising gold deposit. Of course, Darren has had a lot of success in the past in his gold discoveries, but very unique story in that they're nickel and gold. A very interesting story. And I was really pleased to see them stumble on some gold because they were getting no joy in the market for nickel, it seems. So I'm really looking forward to some drill intercepts that are promised very shortly for Balmoral, and I went out and bought some stock when I started realizing the potential. And then Brixton Metals Corporation, I mean, aside from Great Bear, I mean, one of the most exciting drill holes, at least in my newsletter, was that 554-meter vertical hole through a breccia pipe, and the hunt here is for porphyry, a gold copper porphyry, and we're going to hear about that as well. I think a very exciting story that you'll want to hear about. So without anything more, I'm ahead of my time. My wife is shaking her head. She cannot believe it, and that's it for me. So, and maybe she'll be nice to me tonight. All right, so because she always complains I'm too verbose, and I tend to be. So, okay, so we'll go next.